All right, today we are cracking open something that is probably sitting in your retirement account right now, but you might not really get how it works. I'm talking about exchange-traded funds, or ETFs.
I mean, you probably own at least one, right? Maybe a bunch of them. But have you ever stopped to think about what's actually happening under the hood? There's this secret engine that makes the whole thing run so smoothly. And today, we're going to pop the hood and take a look. Okay, so has this ever happened to you? You see on the news the S&P 500 is up for the day. You check your S&P 500 ETF, and it's lagging. Or maybe it's even a little bit ahead? It's weird, right? Well, that little puzzle is exactly what we're going to solve, and the answer gets right to the heart of how these things are actually built. And that little mystery brings us to this three-letter acronym you've probably seen floating around. NAV. NAV. So what is it, really? And why should you even care? Turns out it's one of the most important pieces of the puzzle for understanding what your investment is truly worth. Okay, so here's my promise to you. Stick with me for the next few minutes, and you're going to know more about ETFs than, I'm not kidding, like 90% of other investors out there. You'll go from just owning them to actually getting them. So let's dive in.
All right, first things first. When you hit that buy button for an ETF, what are you really buying? Let's get right to the simple truth.
The easiest way to think about an ETF is like a shopping basket. Imagine trying to buy, 500 different stocks one by one. It would be a nightmare. Instead, you can just buy one share of the ETF, and boom, you own a tiny piece of everything in that basket. It's just simple, instant diversification. But, and this is the first really big aha moment, you're not technically buying the basket directly. What you're actually buying are shares of a trust. It's the trust that holds the basket of stocks. Now that might sound like a tiny, boring legal detail, but trust me, it is the absolute key to understanding everything else. So because of that whole trust structure, we get this really interesting situation, a kind of paradox actually. Every single ETF out there doesn't just have one price, it has two. Let me show you what I mean.
Okay, so on one side, you've got the net asset value, the NAV. Think of this as the official value, the real, calculated, by-the-books value of all the stuff inside the basket. But it only gets calculated once a day, after the market closes. Then, on the other side, you have the market price. This is the price you actually see on your screen, the one that's bouncing around all day long based on who's buying and who's selling. It's pure supply and demand.
So that's the big question, isn't it? If the NAV is the real value and the market price is what people are paying, why on earth don't they just fly apart? What's the magic force that keeps them tethered together? Well, the answer is this incredible, almost invisible system that's constantly working in the background. It's a perfect balancing act. And this is that secret engine I was talking about. And the mechanics of this engine are these guys. These are the unsung heroes of the ETF world. They're called authorized participants, or APs for short. Now, these are big financial firms, and their entire job is to be professional bargain hunters. They make money by finding tiny little price differences, and in the process, they magically keep the ETF's market price glued to its NAV.
So check this out. Let's say an ETF gets super popular, and tons of people start buying it. The market price starts to creep up higher than its real NAV. The APs see this, and they pounce. They go out and buy up all the individual stocks that are in the ETF's basket. Then they take that basket of stocks, deliver it to the ETF company, and in exchange, they get a block of brand new, freshly minted ETF shares. What do they do next? They immediately sell those new shares on the market. That flood of new supply pushes the price right back down towards the NAV. They make a tiny, risk-free profit, and we get a fair price. Everybody wins.
And you guessed it, it works perfectly in reverse too. What if everyone starts selling, and the ETF's price drops below its real value? The APs jump in again. They start buying up all those cheap ETF shares on the open market. Then, they take those shares back to the ETF company and say, here, take these back, give me the actual stocks instead. This is called redemption. And by taking all those shares off the market, the supply shrinks, which pushes the price right back up to match the NAV. It's this beautiful, self-correcting dance that happens all day long. Okay, so that's the engine room. That's how the sausage is made. Cool, right? But so what? Why does this actually matter to you as an investor? Well, let's turn all this theory into a practical checklist you can actually use. First up, let's talk about liquidity. This is huge. Most people just look at how many shares of an ETF trade each day and think, oh, that's its liquidity. But that's only half the story. That's the secondary market,
The real liquidity, the primary market liquidity, comes from the stocks inside the ETF. What this means, and this is super important, is that an ETF with low trading volume can still be incredibly easy to buy and sell, as long as it holds big, liquid stocks like Apple or Microsoft. The APs can always just create more shares for you on the spot.
Next on the checklist, fees. You've probably heard of the expense ratio. It's the annual fee you pay for the fund's management. But here's the thing, you'll never see a bill for it. It doesn't come out of your pocket or your brokerage account. It's much sneakier than that. The fee is just quietly skimmed off the fund's total assets every day. It just means the fund's value grows a tiny, tiny bit slower than it would have without the fee.
So you see a number like this, 0.05%. And you think, that's nothing. And yeah, it is incredibly small. But you gotta remember, that tiny percentage is being charged every single year on your entire investment. Over 10, 20, 30 years, that little fee can really start to add up and compound. So it's definitely something you need to pay attention to.
And finally, let's talk about tracking difference. Think of it this way. An index ETF has one job, and one job only, to perfectly copy its index. But this is the real world, and perfection is impossible. That little gap between what the ETF actually returns and what the index returns, that's the tracking difference. As an investor, your goal is to find ETFs that do their job really, really well, meaning that gap is as tiny as possible.
So, what causes that gap? Well, the expense ratio is a big one, obviously. But there's also the costs of the fund trading stocks internally, how it handles dividends, and even how it tries to copy the index. I mean, does it own every single stock, or does it take a shortcut and just use a sample? All these little things can create a drag on performance.
Okay, we've gone deep into the mechanics, so let's pull back up. What's the big takeaway here? What's the new edge you have now that you know all this?
Let's put it all together. You now get that you're not just buying stocks, you're buying shares in a trust. You understand that there are two prices, the real NAV and the traded market price. And you know about the secret agents, the authorized participants, who keep those two in line. You know that liquidity is a two-layer cake, coming from the ETF and the stocks inside it. And you've got the two key stats, expense ratio and tracking difference, to measure just how efficient an ETF really is.
Look, by understanding this secret engine, you've done something most investors never do. You've moved beyond just blindly buying a ticker symbol. You can now look at an ETF and see how it's built, how it works, and how efficient it is. You're not just a passenger anymore. You're an informed investor, and that right there is a powerful advantage.